Welcome back to Business Performance Week. Really appreciate everyone's patience. You know, when you're running a live event, there's always some wild cards. So we had a little technical snafu, but I'm glad to share that we do have Eric Stearns online and ready to share some insight. Stearns Financial has been a great partner of NAFA. For the members that are on the call, I encourage you through the member portal off nafa.com. Once you get in your login, we have got a great list of our partners, microsites, and a lot of our affinity group, Stearns Financial being one. And hopefully after you hear Eric today, I encourage you to go there. It's a great place where Stearns Financial shares a lot of information, thought leadership, contact information, and really been a great partner. So we're excited to have Eric share some great information around working with nonprofits, 501c3s, credit unions, et cetera. So I'm going to stop. I'm going to turn it over to him. Again, the session's being recorded. Please feel free to ask any questions through the chat or Q&A feature. And if time permits, we will address those at the end. Again, we thank you for everyone's participation today. And I'm going to go ahead and turn it over to Eric. Thank you.
Today's session is really focused on split dollar tax exempt organizations, specifically looking at the credit union industry where a lot of our expertise and background lies. But I want to kick things off by saying, how often do you sit down with a client and can show them how to add $1 million to their bottom line today, this year? Like not over time, not over anything, but just show them $1 million of benefit. And I want to talk to you about how we accomplish that, how much and where we can add that kind of value to a client, the drivers for those and what you really look for, some of the challenges and solutions that we've come up with to get there, and really how to open that conversation and really understand what pieces to look for and how really to approach that. But first, I want to give you a little bit of insight into the underlying construction that we use in general. And we usually start with a collateral split dollar. Essentially, I would call it a deferred comp, though it's nice that it does not fall under the 409A regulations, but under the loan regime. And the way that we describe this working is it's a loan being from a plan sponsor to a plan participant. In this case, we're looking at whether it's a credit union or maybe an educational institution or a healthcare institution or a union, a trade union, a loan being made to the participant. That is a promissory note, and the plan sponsor's asset, the actual thing that they own, is the note, the paper. And depending on the underlying construction of the legal agreement and all the documents that go behind that, we look at the annual income that accrues on that program, whether that is, it could be at the IRS applicable federal rate, it could be greater than that, or it could be less than that. There are different taxation scenarios, and each one of those has a different impact on the investment amount needed, or that loan amount needed to create the program. From the plan participant standpoint, it creates a collateral asset, and that collateral asset is life insurance. We're talking about collateral split dollar life insurance under the loan regime provisions of the Internal Revenue Code. And this loan purchases life insurance. We generally do it or approach it as either a 10-pay scenario or as a single lump sum that has a premium payment account or an immediate annuity that funds that future amount. The collateral assignment gets made on the program itself. That means that there is a lien that's filed on the collateral asset that creates the security back to the plan sponsor. And with all of these moving parts, the eventual goal, or the eventual what you're trying to accomplish here, are non-taxed withdrawals. So we've got non-taxed withdrawals coming out of the life insurance, And there can be imputed income as it relates to the loan if it's below market rate. If that does occur, there is some taxation. The interesting thing is essentially what you're doing is creating a plan for the sponsor that uses the tax regime or the loan regime under this tax code to eliminate or to move taxes away from the program. And that lowers the investment amount when compared to a taxable program when you look at the apples to apples net after tax benefit of the actual program itself. And then finally, the split dollar or split beneficiary aspect of the program itself, which repays the note, the loan, back to the participant, or excuse me, the plan sponsor, and then pays any remainder to the beneficiary or the estate of the plan participant. In this case, nominally the executive. I want to give you a case study and kind of throw out the big numbers first and say, this is what we, one of the cases that we worked on recently, and then walk through a little detail of really what we were looking at. And when we say 501c or nonprofit organizations, we're not talking necessarily about charitable organizations. We're making, we've got salaries that are approaching what you would see commensurate in peer group. In this case, we had a client who had a non-qualified deferred compensation structured under code section 7F09A. And in that scenario, the benefit itself was being accrued as a liability, and that liability then was being offset by an asset that's generating some amount of income. The future payout was going to be in 5 years. In this case, we're looking at a $5 million accrued liability that was on their balance sheet with an offsetting $30 million asset. That $30 million asset then had grown to equal that $5 million accrued liability. But over the next 5 years, they were going to expense another $2 million into the plan, because it was, at the end of the day, 5 years from the point at which we were in this plan, the executive was going to receive a lump sum payout, because under 457F, it's lump sum. You can't do it taxed as received. What that yielded, that $7 million after tax is about 3.5, roughly. That 3.5 million annuitized out to about $270,000 per year net after tax for at least 20 years. The outcome that we got out of this program was providing a $320,000 annual benefit net after tax, or in this case, a tax-free withdrawal, because we did structure it as a loan regime collateral assignment split dollar plan. We included some, say, the long-term care rider and some individual disability insurance as well for the next few years for this particular executive. But rolling it into a unified or holistic package is a very important thing, especially when we're working with boards. We were able to generate $8.4 million of organizational income over the next 5 years. We've got $5 million cost recovery, that $5 million of accrued liability, and I'll explain that a little more in depth. The $2 million of foregone expenses. In other words, we prevented $2 million of expenses. And one of the big drivers of this type of a program, especially in the nonprofit world, 501c world right now, is that there is an excise tax that is 21% of salaries or income over $1 million, which normally you don't see a lot of $1 million salaries in 501c corporations, but here that $7 million payout is recognized in that year as entirely as income. So, with us already at $700,000 salary, a few years from now, they're going to be close to $1 million. That $7 million is going to generate a $1.4 million liability to this organization, or expense to this organization. The I would say replacement plan, but the plan that went in place that took the place of the existing 457F, the collateral split dollar program, had $20 million of new investment. So we, instead of using $30 million, we used $20 million. and that resulted in about a $1.2 million target premium. So it was certainly a very worthwhile venture from everyone involved. It was a large case from our perspective. And it also freed up $10 million of investment that they could use on additional executives. So now we can put a plan in that's going to not only retain the CEO, but also move into the executive management team as well. I'll just cue you to go ahead and advance there, Brandon.
And we are advanced. Thank you, Eric, on source and systemization.
Yep. Source and systemization. So the drivers for this type of program includes the cost recovery and income. And I want to explain that a little more in depth, in that the $5 million of accrued liability really comes from the underpinning legal agreement. In other words, when you have a non-qualified deferred comp plan, as many of you already know, it's technically unfunded. The IRS has provisions for creating a nominal benefit or a nominal investment that can be used to offset or essentially as the metric for how it accrues. However, it's not actually tied to that investment, which means that a 457F or any non-qualified deferred comp plan, if it's terminated, if it goes away, if you just cancel the agreement, agree to terminate the plan, then and as long as there's no payout, then there's no more liability either. In other words, that $5 million on this organization's balance sheet as a liability to pay that future benefit, once the legal agreement terminates, that liability is no longer a liability, and they then have to wash that $5 million back through the income statement to get it off the balance sheet. So that's an immediate $5 million recovery. The excise tax, I mentioned, the income tax is also a large aspect of this. So if we're looking at a net after-tax, apples-to-apples basis on a deferred comp plan with a non-taxed withdrawal, then the organization has to put in less money. They have to put in 1/2 of the money in order to create the same benefit. Because they're not having to gross it up essentially for taxes. The other thing that makes this advantageous in this scenario, a loan regime split dollar plan, as opposed to a 457F non-qualified deferred comp plan, is that you are now leveraging a longer time frame. And as you can recognize, everything we do is some trade-off of time versus money. And if we can extend the time frame under which we have to produce the benefit, then we can use less money to do it. And that's how we recovered the $5 million from this client for this client. And because they didn't have to accrue the future expenses into that liability account, they saved $2 million in the next 5 years. And because we can now take the investment amount and put it into a life insurance plan that's going to pay off upon death instead of paying out at retirement, we now have 25 to 30 years to generate 270,000, in this case, up to 340,000 of net after-tax withdrawal in order to create all of the earnings in the life insurance to generate that. The things that we look for from what creates, stay right there for a minute. That fragment, or the source of this is fragmentation and consolidation. In other words, we look at industries, and whether it's industries or specific 501c areas or geographic areas where there are a lot of different players and there's a lot of different consolidation. Because to us, consolidation really means that the organizations are getting larger, more complex, and you start having a higher level of professional management that's needed for that kind of an organization. Value pattern here, what we see are the underlying things that really make this attractive to an organization, or when the CEO salary is over qualified plan limits. In other words, when they start hitting their head up against discrimination testing or 403B or 401k savings as a percentage of salary becomes too low to create a meaningful retirement plan. The organization itself needs the liquid assets and the cash flow to be able to support this. They have to have a very long-term horizon, of course, because what we're doing is leveraging the length of the organization being longer than the length of the executive's life. So this isn't necessarily a plan for a 501c corporation that is being run as a a community benefit that's really driven. It's driven just by the founder, and it's going to kind of go away when that ends. This is a long-lived organization, especially where there's turnover or resignation risk, meaning they're bringing in professional management, and there's also where there's talent scarcity. In other words, in the market for executive talent, there's a lot of competition, and especially competition from the for-profit world, like you see in universities with football coaches, private versus public universities, the healthcare sector where the executives or top surgeons can be at a for-profit or nonprofit hospital, or in credit unions where, of course, their competition is directly into the banking world. Okay, now I'm ready. Thanks. So I've mentioned a few of these. Who can use this? First, we look at the credit union world. As I mentioned, credit unions. In the credit union world, you see a lot of regulation that is driving credit unions to merge. So we have that consolidation going on. And at the same time, they're becoming more sophisticated and larger organizations. So we see that as an opportunity. Healthcare, up until the events of a year to a year and a half ago, things were in a different place. The healthcare has been in a different world for in the recent past, but their needs are more than ever in order to retain and reward their executive management team who has led them through these challenges. Higher education, often we're not only talking about the maybe a president or provost at a university, but football coaches. There's a case study on Jeff Harbaugh that we use pretty often, where you are using the longevity of the organization to outlive the executive talent. For Jim Harbaugh, that creates this opportunity for a split dollar plan to really work over time. Worker and trade unions, similar scenario. Municipal governments can use this. When we're talking about municipal governments, we look at what kind of career positions, not the political appointees or political or elected officials, but the career rank and file in the municipal governments that they are in there for their entire career. And other 501c organizations. There are a lot of very financially viable organizations that do this. Who can use this? So as an advisory or looking at an advisory practice, there are a lot of ways to approach this. First, in leveraging existing contacts. In other words, if you have, I'm willing to bet a lot of people have, a lot of you may have a member on your local credit, a member of your local credit union, or on the board of directors of a local credit union, or on the board of directors of your local hospital. Those are the kind of the ways in, the path into this is that the board of directors at a 501c organization is really charged with their number one employee as the CEO and setting that compensation system. So the conversation very often starts with the CEO, who hands it back to the board. Board makes some decisions, and then often it will proceed through an HR route or a finance route to put that all together. Advisors who are making a change, just want to move into something new, or adding a piece to their existing practice. Okay, go ahead, and there we go. The nature of the market, because there's no owner, as I said, it's a board of directors and members meaning whether some affinity group that they serve in the community, whether it's actual members at a credit union, or alumni, or at a university, or the current student body, and or other, the actual constituency that they serve. They're mission driven, so often they're not equating profits with strength. In other words, they're making conscious decisions when choosing how they allocate resources at their business to enhance their mission. And therefore, just because they're not turning a profit doesn't mean they're turning a very thin profit doesn't mean that they're necessarily not strong enough for this type of program. And then long-term or long-range planning focus. The kind of downside, but the things to look out for here are the regulation and compliance. Many of these, especially in the credit union world and in others in 501c, are highly regulated, highly examined. They need, it's more than here's a split dollar plan and a sample agreement, let's get your attorney and there you go. There is both written and unwritten rules for compliance and due diligence, so that they can pass their annual exams, their annual audits, and you put these things in place so that, as I say, it shows up appropriately on whether it's a 990 or if there's a disclosure with their memberships. They understand that just because you've given a $3 or $5 or $10 million loan to your executive, it's not a loan so they can go buy a mansion. It's a loan that's going to be recoverable, so you can create a benefit and create that benefit in the most financially advantageous way for the organization. You're going to have full cost recovery. You're going to recognize interest income on that loan and essentially compensate them or create a retirement plan for them with no net accounting cost. Also, there's a very long sales cycle. Very often we're talking to boards multiple times over and over, boards turn over, and then there's re-education to do. So we're talking anywhere from 18 months to years to really drive that part of the business. When we're looking specifically at credit unions, there are a lot of rules and regulations around bank-owned life insurance that all apply to credit unions. The interesting thing is that the National Credit Union Association, the NCUA, and state regulators in their various capacities have, whether it's rulemaking or bulletins or actual legislation, have put in rules on top of that if you're creating the plan specifically around either split dollar and or a non-qualified deferred comp plan. So bank-owned life insurance is a very interesting thing in and of itself, but then they layer on top of that regulatory due diligence, governance, administration, record keeping, and because of the unique nature of each of these types of plans, because it really is custom designed for each executive, it is designed in a way so that there's really no systematic way to approach third-party administration. It's not like a 401k where it's kind of what has to be done, it's there, all the rules are there. Here it's very unique. So doing or planning on that 30-year commitment to have the governance, the administration, the record keeping, the support for the fiduciary responsibilities of the organization in creating this program is a challenge and something that should be taken close account to. When opening the conversation, I like to say that one of the easiest things I get to do on a daily basis is prospecting, because I call up a CEO and I can, the basic idea is you get a really nice benefit that's tax-free and it doesn't cost your organization anything. And the biggest challenge with that, of course, is explaining it in a way that it doesn't sound too good to be true, so that there's so you create that relationship, and then you start going through the education process so they really do understand what it is and how this works, and that turns into a data-driven financial opportunity, as opposed to, I would say, the more emotional sales or the more sales that are focused on retention from a business owner standpoint, where they might be making the decision. Here you're involved with a board of directors who are, for the most part, volunteer, and in their capacity as a volunteer. They of course take that very seriously. They have fiduciary responsibility to the organization. So they look very carefully at all of the different options, all of the different details, and they make a very rationalized decision when it comes to this. The other aspect of that market is that, as you can imagine, if you're working with a community hospital, all the members of the board are members of that community. Or if you're working with a credit union, all of the board members, if that's a teachers credit union, they're all teachers. So putting this and constructing it in their language so that the history teacher understands just as well as the math teacher how all of these pieces come together to create a retention incentive. From the advisor standpoint, of course, the resources on the data analysis and education, there's a lot of industry statistics that are available in each of these areas from various providers, various data analytics companies, and pulling those together to create this story is one of the key aspects of success in this. And then having the auditor and regulator exams, the administration, the phone call or text message that we receive very often is my auditor is going to be in tomorrow. It's a surprise audit, and can we get all of the reports that we need by noon? So all of those, having those pieces together from a platform standpoint is an absolute necessity in this. So we always say that you partner in every way possible for the delivery and administration of these programs. My mantra is that my knowledge set is a foot wide and a mile deep. And that means that we want to partner as much as possible, whether it's suspect and lead generation, board and executive education, all the way to that TPA work, making sure that we have in place this end-to-end continuum to support the eventual program that's being placed.
That is it, Eric.
Okay, that is it. So I've managed to cover everything and not deplete my cell phone battery as we sit here in the dark. So I would like to open it up to questions because I certainly would like to bounce any or answer any questions and just kind of bounce it back and forth conversationally.
Sure.
So,
and Eric, this is Brian Steiner. We had a few. So first, can some of these strategies be combined with premium financing?
that's really interesting. They can be. The premium finance, depending on the organization and how you work it, there are a couple of different ways to combine it. So you can look at the premium finance as how do we just fund the premiums, but we've also done it in a way that I would say that the premium finance funds the premium, the employer funds the interest payments on the premium finance, and then you roll out the premium finance company at year 10 or 12 or 14, whenever it kind of fits into that particular program. And then the employer has the remainder of the loan, or they can begin forgiving that loan as part of a bonus structure in the future. So that, depending on essentially whether the organization wants to use cash flow to fund it or investment to fund it. So if they're cash heavy, they might look at it and say, no, we want to make a big loan and we'll use premium finance, and then we get paid upon death. Whereas a organization that structures itself more in a cash flow perspective is going to really want to look at this as I would say a savings of cash, so that they use premium finance. And then after the premium finance company rolls out, they start to expense it off, which means you have to put less money in eventually in the beginning. But because of the tax advantages, the net present value of that ends up being much higher than just paying them a bonus. So everybody wins in those scenarios. So we do see premium finance in that. The tricky part is the premium finance company does need to be fully collateralized. So the organization's often tasked with having that collateral to create or overcome the initial the difference between the initial deposit and the cash value in the early years of the program.
Excellent, thank you. Now I'm going to test you on this one. I don't want to be naive, but this is state specific. There was a question posed earlier in the presentation regarding loan opportunities within Florida nonprofits, if there were some limitations, and if there were there some alternative options within Florida nonprofits?
Oh, Florida, man. Um, Florida is an interesting state. So yes, there are. However, we actually have the interesting story with Florida is that we initially had some pushback when we went into the Florida market. This was going back 10 or 15 years. And eventually we had got an audience with the Department of Insurance and Financial Services there, and got a letter from them that said, okay, if you set it up this way, you can work under an exemption from some existing rules. So I would say that it works in some instances, but not all. Like we can do it with credit unions, we can do it with universities and hospitals. Whether we can do it with state agencies and municipalities is doubtful. So because of the it's essentially a ban on preferential insider loans, similar to, this is why we can't use this kind of a setup in a for-profit, I would say a for-profit publicly traded organization, because of the insider loan restrictions and Dodd-Frank and the Sarbanes-Oxley. So Florida is, I would say it's tricky, but it depends on where you are and what the exemption you fall under is. So we can do it with credit unions, we can do it in other places, but we can't do it everywhere because of the ban on preferential loans for executives. The specific piece that we leverage there is that, in Florida, there's often a parity rule, where as long as you can, essentially, as long as we can classify the loan as an investment that is used to create a benefit. It's not like making a loan to buy a house or buy a car. You're creating a loan in name only to achieve accounting and tax preferential treatment. Then often we have some success in there. But we want to go through those pieces with the regulators so that they can understand what we're doing and understand that it's not a violation of that and get sign off.
Excellent. I'm impressed that you were able to pull Florida that easy. So good insight.
I said it was years ago. It wasn't easy.
Are these strategies applicable to foundations? Would this work for them?
We've not done much work with foundations because we have seen that because of as I say, it depends on the foundation. Very often a foundation has to pay out a certain percentage of their earnings in order to create, in order to maintain their tax exempt status and to achieve their mission. So we haven't gone down the foundation route because of the longevity and illiquidity of these types of programs. So I would say that maybe, but I don't know enough about it to know for sure.
Okay. And I think we have time for one more. Is there more than one type of non-qualified plan for a tax-exempt org, such as a credit union?
So the types of programs you can put in, if we use the strict definition of non-qualified deferred compensation, everything under that strict definition is going to fall under code section 457 F generally, and it's subject to 409A. And that world is that's the only thing you can do. There are 1,000 ways to design it under that. However, when we switch to a loan regime split dollar plan, because it falls outside of 409A and outside of 457F under a welfare benefit plan, technically, and under the IRC code 7872, then we have a lot more flexibility. So now you can create a different, essentially a separate bucket of those type of plan. Now you can call it a non-qualified deferred comp plan because that's essentially what you're doing. However, because it doesn't fall under that tax code, it's just a much more flexible tool. You can do vesting, you could do, you can get around some of the taxation and some other things. You can also combine the two in very interesting ways. You can use a 457F or a split dollar plan to pay the taxes on the 457F and then create the long-term care and life insurance benefit while there's a lump sum payout of the 457F. So, again, it kind of depends on what the organization is trying to accomplish and what the executive wants. Do they want a big check? Do they want an income? How do they want it to impact taxes? There's planning on both sides to be done to really answer that question for the organization. But from a technical standpoint, there's really just those two buckets.
Excellent. Thank you very much, Eric. I'm glad we were able to rebound early and deliver some great thought leadership. I know everyone on the call is appreciative of us making that work, and some great information, and really excited to have you spend some time with us today. Again, I'd like to remind everybody, as far as NAFA members, logging into our member portal, you can find a ton of information on Stearns Financial, their resources, and interact with them directly. They're a great resource to NAFA, and we encourage you to check them out and spend some time understanding some of the work that they do. Otherwise, I just want to thank everyone for spending some time with us this afternoon. I know we kicked off early with some legislative PRO-ACT topics and really had some great thought leadership throughout the day. We're going to start tomorrow at noon. Shane Westholter from Gateway Financial is going to be talking about growing your practice. He's a 10-time top of the table MDRT producer, just a great industry resource, speaks all over the country. So we're really, really excited to have him and have him start the day. So I encourage everyone to join us tomorrow at noon. Again, if you have an opportunity, please fill out the surveys and solicit some feedback for us so that we, so we have some information so we can continue to evolve our programs and bring you guys what you're looking for. So we thank everyone for their participation. Stay healthy, and look forward to seeing everybody tomorrow. Tell your friends. Thanks very much.